value investors at Brickwood, and it's probably best if I try and define what we mean by value investing. So when we talk about value investing, we're talking about using valuation as our primary method to select securities. And by valuation, I mean the price relative to some sort of fundamental measure, usually earnings, cash flow, or assets. And obviously, value investors are looking to invest at low valuations. And the reason that we do that is that all the evidence says that investing in lowly valued securities earns above average returns over time. So for example, in the US stock market, we have data that goes back 100 years. And over the past 100 years, had you invested in the cheapest third of the market rather than the most expensive third, you would have earned a premium of close to 3% per annum. Now, 3% per annum doesn't sound like a particularly large premium, but when compounded over long periods of time, it really adds up. So over a 30-year time horizon, value investors would have double the money of growth investors. And if you use the whole sample period of 100 years, the amount of money that you would have for investing in the value area of the market would be close to 13 times bigger than the growth market. So really, it's about small advantages compounded over a long length of time. And that's why we do it. We do it because all the evidence says that it works. And every academic study that we've ever seen agrees with that. They argue about the reasons that the value premium exists, and maybe they argue about the size of it depending on which market they look at, or over which time period they're looking at. But they all agree that investing in lowly valued securities earns above average return. So that is why we do it. So value investing has a very long history of working. So we obviously think it will work now as it has done over time. I think the real reason for investing in a value fund today is more about what you're avoiding by investing in that fund. So at the moment, the broad market indices are very expensive. So we use a valuation metric that we call a CAPE yield. So CAPE stands for cyclically adjusted price earnings. And rather than just valuing a business on a single year, it averages earnings over a trailing 10-year period and adjusts for inflation so that you have a real 10-year average earnings number. And then it expresses it as a yield, so that average earnings over the market cap. And it turns out that when you look historically, the CAPE yield is a very good predictor of future returns and actually maps almost perfectly to future 10-year returns. So for example, if the CAPE yield has historically been 4 to 6%, your 10-year return has averaged about 5%. So what does that mean when we think about the markets today? So as I said, the broad market indices are very expensive. The CAPE yield on the US stock market, for example, is 2.5%. The US stock market makes up a very large proportion of the MSCI All Company World Index, the global benchmark. And so that index is not quite as expensive as the US market, but it's still on a sub 4% CAPE yield. So we think what that means is that future returns from here are likely to be low. The other problem and why investing in those broad indices at the moment we think is a risky proposition is concentration. So the top 10 holdings in that index are about 25% of the overall market capitalization. And those companies all have an overriding theme to them. They do slightly different things, but essentially they're all making very, very big bets on AI. Now, we are absolutely not saying that AI is not going to change the world. We can see that it clearly is. But whether those companies will be able to profit from their investments in AI it's very, very uncertain. And so when you have such a large share of the benchmark, which is effectively taking a single bet, we think that's quite risky. So the combination of high concentration and very high valuations mean that we think investors should really avoid investing in the broad market index. And we think the perfect solution for investors to try and avoid those concentration risks and avoid the very high valuations is to invest in a value fund. So we think that by far and away the most important thing for investors is to have some allocation to value, and whether that's through a Brickwood fund or another value fund, it's much more important to have some exposure rather than who you've gone for in terms of implementing your value strategy. The one thing I would say is there are far less true value investors left than there were 20 years ago. It has been a very difficult period for value right up until the pandemic was a very difficult period, and that has meant that lots of value investors have dropped out of the market. So there aren't that many. And if you think about, well, what are the differences between us and, let's just say, the broad value indices? I would say that there are sort of two main differences. The first is that we spend a lot of time thinking about quality. So we're definitely not quality investors, we're value investors. But if we have two similarly lowly valued companies, we want to go for the higher quality business. And we recognize that it's sometimes worth paying a small premium for a very high quality business rather than getting very low quality business on a slightly lower valuation. And so we recognize that explicitly with the screens that we run. So we run a Cape Yield screen, which I've described earlier, but we also run something called a Greenblatt screen. And Joel Greenblatt was a value investor, but he said, yes, you want low valuation, but it's also important to consider quality. So he ranks all of the companies in the universe in terms of, firstly, valuation, and then secondly, quality, and it's the best combination of those two. And because we run both of those screens, I would say relative to the broad value indices, we have less what I describe as low quality businesses. So the value indices are dominated by banks, mining companies, oil and gas. We have some of those, and you would expect value investors to have some of those, but we have much less than the indices. So that's one difference. Another difference is that we spend a lot of time thinking about the cyclicality of the portfolio, and we want our portfolio to perform in as wide a range of scenarios as possible. So we don't want to bet the fund on one outcome, on sort of red or black, and hope for the best. So we deliberately set up the fund to have a reasonable allocation to both cyclical and defensive businesses. And I would say relative, again, to those broad value indices, we're probably a bit more defensive. So typically, value investments have tended in the past to be more on the cyclical side. So those companies, those industries that I mentioned before, banks, oil and gas, mining, they are cyclical areas of the market. And again, we own some of those, but we would be less cyclical than the broad market averages for let's say the MSCI ACWI Value Index.